What's up, everyone, and welcome back to the Babalian Money Show. Today we re-tackling the big question on everyone's mind. When is the next bear market going to start? We've seen some incredible gains, but we all know what goes up must eventually come down, or at least take a breather. So, are we on the brink of a major downturn? Let's dive into it. First off, a quick disclaimer. I am not a financial advisor, and this video is for informational and educational purposes only. Investing involves risk, and you should always do your own research and consult with a professional before making any financial decisions. Your capital is at risk, so invest wisely. Now, let's get into the meat of it. Predicting the exact start of a bear market is like trying to catch a falling knife. It is incredibly difficult, and many have tried and failed. However, there are several key indicators that can give us clues that the tide might be turning. Think of these as the warning signs on the economic highway. One of the most classic indicators is rising interest rates. When central banks, like the Federal Reserve in the U.S., start hiking interest rates, it's usually to cool down an overheating economy and curb inflation. Higher rates make borrowing more expensive for both consumers and businesses. This can slow down spending, reduce corporate profits, and make stocks look less attractive compared to safer assets like bonds. We've seen this cycle play out time and time again. When the cost of money goes up, the party in the stock market tends to quiet down. Keep a close eye on the Fed's announcements and their future projections for interest rates. It's a huge piece of the puzzle. Another big one is the yield curve, specifically when it inverts. Now, this sounds a bit technical, but the concept is pretty simple. Normally, long-term government bonds have a higher yield or interest rate than short-term bonds. This makes sense. You'd expect to be paid more for tying up your money for a longer period. But sometimes, this relationship flips, and short-term bonds start paying more than long-term ones. This is called a yield curve inversion. Historically, an inverted yield curve has been one of the most reliable predictors of a recession and a subsequent bear market. It signals that investors are worried about the short-term economic outlook and are piling into the safety of long-term bonds, driving their yields down. It's not an immediate trigger, but it's like a storm cloud on the horizon. Then we have market sentiment and valuation. Are stocks getting ridiculously expensive? We can look at metrics like the price-to-earnings or P/E ratio, especially the Shiller P ratio, which adjusts for inflation and business cycles. When these ratios reach historical highs, it can suggest that the market is overvalued and ripe for a correction. Think back to the dot-com bubble in the late 90s. Valuations were through the roof for companies with no profits, just a comma in their name. We all know how that ended. Extreme bullishness, where everyone is convinced stocks can only go up, is often a contrarian indicator. When your Uber driver starts giving you stock tips, it might be time to be cautious. This is what we call irrational exuberance. Economic data is also crucial. Watch for slowing GDP growth, rising unemployment, or declining manufacturing and service sector activity. These are signs that the underlying economic engine is sputtering. A strong economy supports corporate earnings, and a weak economy does the opposite. If companies start reporting lower profits and guidance for the future, investors will naturally reevaluate what those companies are worth, often leading to lower stock prices. Consumer confidence is another one to watch. If people are worried about their jobs and start saving more instead of spending, it can create a ripple effect throughout the entire economy. And let's not forget about geopolitical events or black swan events. These are unpredictable, high-impact events that can send shockwaves through the financial markets. Think about the global pandemic in 2020 or the financial crisis in 2008. These events can trigger a sudden loss of confidence and a rapid sell-off. While you can't predict them, you can prepare for them by not being over-leveraged and having a diversified portfolio. So, with all these indicators, where do we stand right now? Well, it's a mixed bag. We've seen inflation running hot, which has prompted central banks to start tightening their monetary policy. The yield curve has shown some worrying signs at different points. Valuations, particularly in certain sectors like tech, are still quite high by historical standards. And there's no shortage of geopolitical tension around the globe. On the other hand, the labor market has been resilient in many parts of the world, and corporate earnings have held up better than many expected. There's still a lot of cash on the sidelines, waiting to be deployed, which could provide a floor for the market. So, when will the bear market start? The honest answer is nobody knows for sure. It could be next month, next year, or we could see this bull run continue for longer than anyone expects. The key isn't to perfectly time the market. That's a fool's errand. The key is to be prepared. How do you prepare? First, have a plan. Know your risk tolerance and your investment timeline. If you're young and have decades until retirement, a bear market is actually a huge opportunity to buy great companies at a discount. If you're nearing retirement, you should be taking steps to protect your capital, perhaps by shifting more of your portfolio into less volatile assets. Second, diversification is your best friend. Don't put all your eggs in one basket. Spread your investments across different asset classes, stocks, bonds, real estate, commodities, and across different geographic regions. A well-diversified portfolio can help cushion the blow during a downturn. Third, keep some cash on hand. Having a cash reserve not only acts as a safety net, but also allows you to be a buyer when everyone else is selling in a panic. This dry powder can be your most powerful tool in a bear market. And finally, control your emotions. The biggest mistakes in investing are often driven by fear and greed. During a bear market, it's easy to panic and sell everything at the bottom. Sticking to your long-term plan and avoiding knee-jerk reactions is what separates successful investors from the rest. Remember, historically, every bear market has been followed by a new bull market that reaches even higher highs. The stock market is a long-term wealth-building machine, but you have to be able to ride out the downturns. So instead of trying to predict the exact day the bear market begins, focus on what you can control: your strategy, your diversification, and your emotions. By building a robust, all-weather portfolio, you won't have to fear the bear. You can be prepared to weather the storm and even take advantage of the opportunities it presents. That's all for today's deep dive. I hope this gave you a clearer picture of what to look for and how to prepare. It's a complex topic, and we'll definitely be keeping an eye on these indicators in future videos. If you found this helpful and want to stay updated on all things finance and investing, do me a huge favor and hit that subscribe button for the Babalian Money Show. It really helps the channel grow. Drop a comment below with your thoughts. Do you think a bear market is just around the corner? Thanks for watching, and I'll see you in the next one.